Tjena! The Twitter stock is now valued to 1/30th of Facebook and to 2% of Google. So, is the Twitter stock misunderstood and it will go 10x from here? Or is it the case of hopeless mismanagement and you should just give up and cut your losses? I'm CTO Larsson, let's find out. Here is Twitter stock development, here is Google, here is Apple, here is Facebook. As you can see, a good guess is that Twitter shareholders have not been so happy these past 6+ years. We can add Snap to be nice. Still, this is an absolute disaster. Despite that, I bought some Twitter stocks today, and I'll tell you why. First, why has the stock been such a disaster? If we look at valuation, it seems like the market has gone mad. Twitter market cap is 23 billion, Facebook over 600 billion, Google almost 1,000 billion. Market cap is the value of all freely trading stocks, like the value of the whole company. How can it be like that? We need to dig down to understand what is going on. Twitter has 166 million of what they called MDAU, monetizable daily active usage. That's like logged in people or organizations that accessed Twitter on a day that they could show ads to. The Facebook family of apps, which is then Facebook, Instagram, Messenger, WhatsApp, has 2.3 billion daily active users and 3 billion monthly active users. On a quick search, I couldn't find a reliable number for Google, meaning Google Search and YouTube and Gmail, etc. So I just guessed on 3.5 billion monthly. China doesn't use it, for example. Then I guessed half of that daily. If anyone has a reliable number for Google, please let me know in the comments. Revenue is a lot easier. Twitter made 3 billion last year, Facebook 70 billion and Google 160 billion. Then I calculated one of my favorite numbers, which is like our gold standard in telecom, ARPU, which stands for average revenue per user, meaning sales in USD per user in a month. I want to use the monthly active users, which I don't have for Twitter, so I guessed it's double of the daily. Then we get that Twitter has an ARPU of little less than $1, Facebook $2 and Google $4. If we continue to look at profit, Twitter made a loss last quarter, Facebook had a 33% operating margin and Google 19%. Now the valuation starts making a lot of sense. Look here at market cap per daily active user. The market values a daily active user on Twitter to $130 and on Facebook double that, $260. Makes a lot of sense, right? Since Facebook has double the ARPU of Twitter and makes fantastic profit. Google even more, though not exactly apple to apple. I'm pretty sure this is more or less what lays behind the current valuation of Twitter. Every Wall Street analyst has done exactly this exercise on their computer or on their napkin. Looking at it like this, suddenly Twitter doesn't look so cheap, right? It looks fairly valued or even a little expensive. But I'm going to ignore all of this. I took a completely different perspective on this and I bought shares for 2 reasons. Number 1, the value of the network. Business at the core is about adding value to people. The rest usually follows sooner or later. And I find only 2 social networks add real value to me today, and that's YouTube and Twitter. All the rest could disappear tomorrow for all I care. It wouldn't affect me in any way. Instagram, Facebook, TikTok, LinkedIn wouldn't affect me if they all closed tomorrow. But if I lost Twitter or YouTube, I would feel quite handicapped. Like someone wrote, Twitter DM is the real LinkedIn. That's where you actually get hold of people that matter. The key opinion leaders are on Twitter. If you want to get hold of a big CEO, write to him or her on Twitter, and he or she might actually read it. That's not going to happen on TikTok or Instagram, and they're not going to accept your friend request on Facebook. The value of the Twitter network is, in my opinion, enormous. So when we are looking at those ARPU numbers, average revenue per user, and comparing Facebook and Twitter, Facebook has higher ARPU, while I bet you my last penny that the average income and average wealth of those Twitter users are a magnitude higher than the average Instagram user, for example. It's just complete failure in monetizing it. Or maybe they didn't want to. Jack is a spectacular and very unique leader in so many ways. Maybe his priority never was to make as much money as possible, but to build a great inclusive communications platform for the people of the world. And in that case he has succeeded brilliantly, best in the world. But I think the shareholders who appoint the CEO will soon be fed up with the stock performance and replace him with someone who executes on these KPIs. I'm not saying that's a good thing or that I wish for that. I'm just saying that I think that is what will happen. And then look at the growth potential. In number of users, in ARPU. If can grow users 3 times and ARPU 3 times, that would warrant a valuation of at least 10 times higher than today. Second reason is the chart. There are only 2 support lines in this chart, and it's where we are now, just below 30, and the double bottom here at 14. Twitter went down quite a lot last Friday because of the so-called Facebook ad boycott, which I think is a sentiment issue that will soon pass. If we take a step back, do we really want to replace laws formed under democratic principles with terms and condition sheets of private companies? I don't think that's what anyone truly wants. On the upside, the price failed to break out twice from this range, both in 2018 and in 2019. So we are at the bottom of one trading range now, with another trading range just below. If we stay in the current trading range, this is the bottom right here, meaning a favorable risk-reward ratio. If we break down, it means we drop into the range below. Then I'll cut part of this buy and try to buy it even lower near the bottom of that range. That can very well happen. There has been no corrections on the stock market since this rise started in mid-March. Maybe the ad boycott expands, maybe a lot more companies jump on this and all the social media companies take a huge dive. Or maybe the stock markets crash after the US elections are over when the aggressive stimulus takes a break. If it drops to 14, 15, I'll get an average entry of I think around 19. If it drops significantly below the previous bottom, I'll exit on a loss and then reassess. In total, this gives me a downside risk of about 30%, which is quite high. But as I showed, I think the upside potential is 10x over a few years. If I manage to get in here, I'll just wait, because I think there is a possibility that they start capitalizing on the gold mine they sit on eventually. So this is a long trade, this is not a short swing trade, it's an advanced play. And one of my many bets, most of which will fail, while I expect a few will make such high multiples that it will compensate for that and much more. There is big money to be made in taking a long-term perspective on big moves when everyone else is short-sighted. I do recommend the tools and process in my course on ctolarsson.com. We're absolutely killing it in the market with this toolset and process. This video is not advice. I'm just trying to share how I'm reasoning, hoping that you will find it educational and that you can pick up a few points and apply to your own trading. And do subscribe to my channels matching your interest. You're right now on the Invest channel about tech stocks and financial education. Then I have 2 more. Thank you. Tack. CTO Larsson out. Hej då!